Hi, Lee Phillips here. I got involved a lot with the life insurance industry a while back, and what people don't understand is life insurance can actually be used as a tax shelter. The laws associated with life insurance basically say that the life insurance cash value grows without a tax. That sounds like an IRA, doesn't it? Yeah, it does. In fact, life insurance can be used as an IRA substitute. And in some cases, it works very well because you can put the money in, you pay the tax on it, you put the money in. You can't do it tax deductibly usually. So I put the money in, a couple of tricks, and that is one, you need the minimum amount of actual life insurance because the death benefit costs you. It's called the cost of insurance. And the death benefit takes money out every year or every period. So we want the minimum amount of life insurance and the maximum amount of cash value or money that grows if we're going to use this as an IRA substitute. The minimum amount of life insurance has to be printed on the illustration that you get from the life insurance company. It's called Guideline Premium, and it is buried in those 30 pages of stuff they give you for the illustration. Has to, by law, give you Guideline Premium. That's the minimum amount of money that you can spend on the insurance and the maximum amount that you can put into the cash value. If you put too much into the cash value, it's not called insurance. It's called a modified endowment contract. So I've got to have the right amount, but I want the minimum amount. The agent isn't going to sell you the minimum amount because the agent only gets paid on the portion of the cost of insurance. They don't get paid on what you put into cash value. So the agent always wants to increase the insurance. So we put the minimum amount of insurance and we put money in. The nice part about this is there's no limit like there is on an IRA or a 401k as to how much money I can put in. And that money, as it grows in the cash value, grows without a tax, which is a big deal. That's why your IRAs and your 401ks and everybody does so well. They grow without a tax. So we're growing the money without a tax. How do I get it back? Well, if I cash it in, one, there's often surrender charges, and two, any increase in the cash value comes out to me as income. I have to pay income tax on it. The insurance companies have set it up so that you can actually borrow the money back out, or at least a percentage of it. And if you borrow it back out, you can spend it anywhere you want. It's borrowed money, so you don't have to pay a tax on it when you get the money out. Here's the catch. The catch is, if I borrow the money out, the insurance company is going to charge me an interest. The way it works is, if I borrow $100,000 out, the insurance company takes $100,000 of my cash value, they put it in a penalty box. Then, to make it a loan, the insurance company gives me $100,000 of their money. Now that's a loan. But it's 100% secured with my money in the penalty box. So I've got the money. They're going to charge me interest on this. They're going to pay me interest on my money too. What they usually do is they charge you a 1 or 0.5% or something interest on the money that they give you above what they pay you. So if they pay me 5% and they charge me 6%, I'm out 1%. And the insurance guy's going to go, well, yeah, so what? 1%? You show me where I can get money at 1%, I'll borrow as much money as I can get. Well, yeah, But it's my money. So what you have to do, and there are getting to be more of these, there used to be like 4 10 years ago, and now there might be a half a dozen. You need to get a contract with the insurance company. They'll call it a zero wash loan. It has to be in writing, guaranteed in writing, that they will charge you 5% and they will pay you 5%. Or they will charge you 5% and they'll pay you 5%. So it's a zero wash. And they say, well, we've never charged more than, we've never charged an interest on this life insurance policy. Yeah, that's right. Because they only sold this life insurance policy for 5 years. And you can't borrow money out of it for 10 years. So no, they've never charged an interest on the money that people borrow. They'll say, well, we only charge historically a 1/4%. Yes, but the easiest way in the world, and the insurance companies do this routinely, the easiest way in the world to increase the insurance company's bottom line is to increase the interest on all of these loans by 1/4%, 0.5%. That's millions and millions and millions of dollars. So it has to be a zero wash. I have to be able to borrow the money. Has to grow without a tax. But that is the definition of a tax shelter. The nice thing about it is I'm a little company guy. I don't have to include my employees in this thing. I'm not restricted as to how much money I can put in it like I am on an IRA. If I do a 401k and I've got employees, they got to participate. I got to help them. So under certain circumstances, this concept of using life insurance as a tax shelter, it's really not a bad idea. The problem is they don't pay you too much in interest on this money. I've actually got a policy right now I've had for 5 or 6 years, and I've basically earned no money. So I'm going to cash it in and take my money and put it someplace else. So yeah, it works. And I've got half a dozen of these policies myself. I've got hundreds of thousands of dollars in them. It works, but it doesn't work as well as if you could put the money in a 401k, solo 401k, or even your IRA. Max those out first, all right? Lee Phillips talking about life insurance as a tax shelter.